Stocks are trying to hold their gains right now, even though inflation came in a bit warm. Bonds are firm, and market has rewarded Microsoft and Alphabet for its growth in artificial intelligence. It's going to be a fun session with just about every theme at play. Joining us to begin the discussion, Kathryn Rooney Vera is the Chief Market Strategist at StoneX. Kathryn, always great to have you here. Thanks for being with us this morning.
Thanks, Oliver. My pleasure.
So we've got basically a little bit of everything today, right? We've got inflation, we've got earnings from AI. What do you think is going to drive the bus here into the weekend?
I love how you phrase that. So far, so good in terms of futures, because the market is thinking, hey, it could have been worse. Inflation could have been worse. But the fact of the matter is that the risks are rising of what we call stagflation, which is the risk of high inflation and a deterioration in the economy. And I think the risks are rising therein. One of my calls coming into this year, Oliver, was protecting portfolios, and those trades have done remarkably well. And we're talking about put options, long put options on the technology sector, on the S&P, because it's a third based on technology. So look, there are opportunities in tech. I just wouldn't be buying them in terms of the high flyers that have soared over the past year. And I think that really when we're talking about AI and the motors of growth for the Mag 7 and the S&P, I think AI has to deliver now. I think AI has to deliver, and I think that earnings have to match multiple expansion, which was the main driver of last year's resurgence in the S&P.
Let's talk about delivery of AI product first, because I do think that's crucial here. Is the market started selling finally some of those super high momentum picks and shovels chip makers. The question was, all right, what about the products and the services? Do you think so far we are living up to expectations based on what we're seeing from Microsoft, Alphabet, Copilot, some of the other stuff they're trying to do? I mean, a lot of folks are saying this is like stage one. Should it be, though? I mean, should we be getting something more concrete, or how do you feel, Kathryn?
I think the markets are obviously forward pricing in what they expect to occur over the coming years. So AI is going to be an important part of the economy. The issue at hand, Oliver, is that we've baked in the best of the world, and the world meaning that AI, we have baked in full deployment of AI. So the biggest macro argument in favor of economic growth continuing, inflation not being an issue, is productivity. Productivity soared last year. We're talking beating the 25-year average here in the United States. Productivity growing 2.7%. That is, if you are a bull, and respect to the bulls, but if you are a bull, you must then think that those rates of productivity continue in a sustainable fashion. The way they continue is because AI has already been fully deployed. And I don't know about you, but talking to other banks, StoneX being one of them, and others as well, there's a lot of talk about full deployment of AI. But when the rubber hits the road, how much has actually been executed? And it hasn't been. So I think this is something that there's a bit of hype here. I think there's a lot of worthwhile arguments to be made about AI. But to sustain these levels of productivity and to thereby counteract high rates of inflation, we're not there yet. That's my view. I think a lot of the productivity gains have come off of the back of major losses during the pandemic. And I suspect that the markets are underappreciating the risks inherent in them, which are, in my view, two fat tail risks. One, overheating of the market, which I think is lessened in risk now. And the other is the possibility of stagflation, which is recession and sticky inflation. Okay.
To your point also on productivity gains, we had some nice productivity figures in the data over the last year, especially when we were very clearly still disinflating. That seemed to be something to celebrate. Now, as yields are breaking back out, does that help kind of facilitate the repricing of valuations? Do you think that that's kind of forcing some of this pressure onto the market, Kathryn? Have we become a little bit more dependent on bonds like 2022 again?
Yeah, productivity inherently helps disinflation. So when you have productivity gains, it's easier to disinflate. So we would have to maintain those productivity gains. The issue right now, I think, is that corporations here in the U.S. face pretty intense pressures on their margins, and I suspect that they may come to the fore. And those come from high energy prices, high labor costs, and high real cost of capital. And so if that's the case, then we probably, Oliver, see a reversal of job hoarding. Over the pandemic, everybody was talking about job hoarding. keeping guys on the payroll because it's so hard to replace them and find adequate employees. But when it comes to the end of the day, you really need to cut costs. You're probably going to cut some of the fat in the labor force. And if that starts to happen, then I think that's the nail in the coffin, and we get a retrenchment on consumption. We had personal spending out today. People are still spending, and you can see that in the absolute value of credit card debt, which is surging. People are still spending. That's because they have jobs. Once that changes, you're going to see a big jump in delinquencies and defaults, both on consumer loans and I suspect car loans, as well as other business lending.
There's a great connection here that I just want to come back to for a sec. I ask you about those two main threats, but that connection is between what you kind of see as the peak of efficiency, then leading to the breakdown of the labor market. Because so far, as we've been able to wring some efficiencies, as you mentioned, kind of the job hoarding, we've been able to maintain the level of jobs that we've got. So it sounds like if you think efficiency has been maxed out, then okay, then it comes down to basically just reducing overhead and costs, which breaks the jobs market, which makes me think in your two main risks, you're erring more towards like recessionary style kind of slowdown as opposed to the overheating.
Yeah, and thank you for that awesome synopsis. Yeah, I think that the risk of recession is about 40%. That's double the norm in any point of the economic cycle. And that 40% risk for recession, I think, occurs over the next 18 months. It's not a 2024 event. The labor market is just too darn strong to facilitate a recession. But as the Fed maintains, we can argue whether the restrictive levels or not, but as the Fed keeps nominal rates at 525 to 550 for an extended period of time, which I think they will, then you're going to see the negative effect on consumer lending and corporate margins. And I think that increases the risk of recession. The question is, does inflation follow suit? I think it does, because the biggest combatant to high inflation is effectively recession. So if in fact we're going that route, and I do believe that we are in the late stage of this economic cycle, then I think portfolios are wise to go long, for example, 2-year treasuries up 5%. Or starting to, today we saw a bit of a flattener in the treasury curve, start to go the opposite direction. I like to think a bit contrarian. When the markets were baking in euphoria and the perfect landing, well, this is the perfect landing that wasn't, right? So when the markets are at their peak in terms of greed and valuations, that's when you deploy the put strategy. And I think now you want to start looking at the possibility of the Fed reacting by dropping rates because of the potential for rollover. Just thinking a bit against the grain, and I think that there's a lot of money in money markets that probably will find a home in short duration treasuries soon.
Well, certainly to your point there, kind of contrarian to the last couple weeks in particular, as we've seen rates blow out. If your kind of macro lean is that jobs are going to start to break down, the market has become more confident in the last couple months that's not going to happen. They've reduced the cuts from the Fed. But then, of course, that brings up that stagflation question. Do we get a scenario where things slow down, the Fed can't cut? I mean, that's essentially kind of the worst case. What are those odds at if just kind of recession's at 40%? What about kind of stagflation odds where we slow down and Fed can't cut?
Well, slowing down is the soft landing. It's so interesting, Oliver, because we were all talking about soft landing, and that was the ideal scenario. Now we're getting the soft landing. The issue is that inflation is not moving in the direction that we would have wished. But we were expecting this soft landing, and in fact, it's a good thing. We don't want to see an overheating of the economy with inflation already where it's at, especially when industrial policy, which effectively means protectionism, is now like the go-to for both sides of the aisle. Republicans, Democrats, everybody's into it now. So that's inflationary. So I think we want to see a slowdown in the economy. I think we want to allow the natural cycle of the economic cycle to come to fruition. I think what we want to avoid, at least from my perspective, as a more kind of free markets economist, is to get the Fed out of the picture. Get the federal government out of the picture, because what happens is that inflation just keeps rising and it becomes inherently sticky, and the markets lose faith in the credibility both of the U.S. Treasury in terms of its capacity to pay over the next decades, as well as the Fed in its capacity and its intention to get to its dual mandate, which is trend 2%. It's not let's hit 2% and jump off and we declare victory. It's trend 2%.
Hey, Kathryn, just real fast. So you think the move is just a straight buy downside? I mean, that's pretty aggressive. When you talk about buying puts, is that the move right now instead of just avoiding this stuff or like, buying unhedged stuff? You think it's to outright bet against it?
Well, I recommended the put option, when we were a couple months ago at the major breakouts. That's when I recommended the put option. So right now I'm recommending defensive stocks, defensive sectors and value sectors. I think that's the play today. And I think the play today is, as I mentioned, 2, 3, 5-year treasuries, which are pretty juicy yielding under the expectation that $6 trillion that's sitting in money markets right now doesn't go into the equity markets. It goes into a comparable and similar asset class, which is the short-term treasury market.
Okay, so the kind of froth has come off a little bit. Would there be a signal for you to then shoot for more downside? I like the clarification of, still being long stocks, but kind of shifting versus betting against it. What would be that cue to take another stab for a real sell-off?
Yeah, I mean, look, I think that there's momentum to the market. Earnings are not horrible. And I think that the economy has shown that it's not vulnerable or not too vulnerable to Fed hikes to 525, 550. So I wouldn't bet against, but I am recommending hedging risk assets. So hedge yourself. And that's what we've done. And that's been our best trade of the year. Gold was our top trade of the year. It's done remarkably well. I'm looking at gold miners now. Any retracement in miners, I think, is a buy. And I think it's a very attractive bet for guys and gals who want to be in the markets. And I think we should be. But we should be in a pragmatic way, incorporating other asset classes that tend to outperform in stagflation or recession, which I think the markets are beginning to increase their possibility in terms of their probability.
All right, understood. Love bringing it home to the trades from the macro discussion. Appreciate it, Kathryn. Fun chat.
My pleasure, Oliver. Thank you.